Hey, I just wanted to close up a few loose ends on the mutual fund week with a couple of things as I've looked through the videos that I wanted to kind of have you go back to your book and pay particular attention to. One being target dated funds. I gave you a little assignment on Vanguard. So a target dated fund is a fund where they assume you're retiring in a certain year. So let's say you're going to retire, you're 30 years old, you're going to retire when you're 60. You'd buy a target dated fund that would be 30 years from now. And basically what that is you'll notice that the target dated funds invest in other mutual funds. And basically the closer the fund gets to your retirement age or its fund year, the less risky it will be. So 30 years, it's most, if it's going to invest for the next 30 years, it's mostly stocks. As it gets to maybe 10 years, the stock bond balance will be maybe 50-50, and then as it gets closer to the maturity of the fund date, the retirement date, it'll get less risky. So similar to whether when you're going into retirement, if you're young and you can weather ups and downs in the market, that's what the target dated fund will do for you. So look closely at those. A lot of your 401ks will have those in them, and it allows you to kind of be diversified and be aggressive without having to pick and choose specific funds. The other types of funds that I wanted to talk about that I didn't see in the videos, one is a closed-end fund. So a closed-end fund is different than a mutual fund. Mutual fund, a lot of people put money into it, and then the investor, the manager goes out and invests in mutual funds and stocks and bonds and all that good stuff. So with a closed-end fund, there's, with mutual funds, you can get as much money in there as you want. The closed-end fund, it's a set dollar amount. It's already in there. And so when you buy into it, you actually have to buy into it from one of the other people that already owns the stock. So they don't create new shares like they do in a mutual fund. It doesn't get bigger and bigger and bigger. It stays pretty much the same size, and you buy into that fund. Similar to, let's say, some business owns, has 10 owners. If you want to buy into that business, one of those owners has to sell you part of his or her shares. So that's how a closed-end fund works. Part of that, and very important, I want you to go back probably if you haven't and read the ETF section. ETF is relatively new. There's a lot of them because they become very popular. But a mutual fund starts with money. People put money in and then they go out and invest in stocks. An ETF is put together, it's kind of a basket of stocks. So you have, they go out and they can be very specific. It can be an energy ETF. It can be a social well-being ETF. It can be anything that's in a particular sector, or it can be an indexed ETF. And so it works a lot like a closed-end fund where you can buy and sell in and out of that fund during the day. It works like a stock, but it's a basket of stocks. So pay particular attention to it, because you may end up, as you get into your mutual funds and your investments through your 401k, you may actually be able to buy into ETFs. And very good way, again, of diversifying, but also targeting a specific sector. And the last thing I want to talk about very quickly is a hedge fund. So you hear about that on the news. What is a hedge fund? Well, essentially, a hedge fund is an investment company, right? So, but well beyond stocks, they actually buy companies. They may buy into existing companies. They may, put money into an up-and-coming company, an Uber or a Lyft when they first started. Somebody invested in those companies. You had some venture capitalists go in there and put money in there. So a hedge fund is very much like that. There's lots of money, tends to be very high worth individuals, buy into these hedge funds, and then the hedge fund manager goes out, buys companies, buys parts of companies, makes investments in real estate. They may buy a building in New York. It can be anything, really, and you kind of trust that money manager or that hedge fund manager to make the investments appropriately. And there's a very different fee structure there too. It's usually at what's referred to as a 220. So the hedge fund manager will take a 2% fee every year out of the fund, and then they'll share in the profits. So they'll get 20% of the total profits of the fund. So therefore, they're very motivated to make money. So that works out for the investors. It also works out for the hedge fund managers. So they're very careful in who they invest in. So a quick video just to tie things up. These are what I felt was very important based on the other discussions that were going on. When you go into Vanguard, poke around in there. It's one of the biggest mutual fund companies in the world. If you're opening up a new account and you don't have a lot of money and you want to just be in a good place, that's a good company to look at. Fidelity's of another good company. But I had you poking around in the Vanguard site just to kind of get used to it. So sorry again for all the videos this week, but important week.